Welcome to RichTrybe. Today, we're tearing down the curtain on exactly how the ultra-wealthy actually structure their money. Because here's a hard truth that nobody tells you. For the average earner, taxes are the silent wealth killer. You can grind away at your job, save diligently, and invest consistently, but if you're putting the wrong assets in the wrong accounts, you're basically running on a financial treadmill while the IRS just keeps cranking up the speed. Well, we're going to fix that today.
Hold on a second, John.
If taxes are this ultimate wealth killer, why would anyone even bother using a taxable brokerage account in the first place? I mean, if capital gains are just going to eat away at my profits every single time I make a move, aren't I literally just volunteering to hand my wealth over to the government? Shouldn't we all just stuff everything into a 401k or an IRA and call it a day?
That is a totally fair question. Let's get into Section 1, the wealth tax trap, and how to make sure you don't let taxes eat your earnings. Look, Monique, you absolutely should max out those tax-advantaged retirement accounts, for sure. But at a certain level of wealth building, you're going to need taxable accounts for liquidity and unrestricted growth. The real secret? The rich don't use shady, illegal loopholes to protect these accounts. They just deeply understand strategic investing and tax avoidance. They legally organize their money so it grows virtually untouched by the IRS.
Which brings us perfectly to Section 2, Rules of Asset Placement. Because where you put it actually matters. It's this millionaire concept known as asset location. Now notice I said location, not allocation. Asset allocation is about what you buy. Asset location is entirely about where you put it to stop the tax leakage.
Okay, so give us a crystal clear definition here. What does tax-efficient asset location actually mean in the real world for someone watching this explainer right now? Simply put, it is the strategic placement of assets to maximize your after-tax growth and minimize tax liabilities over long periods of time. The big takeaway is that you want to shield your highly taxed assets by stuffing them inside retirement accounts while putting your naturally tax-efficient, high-growth assets right into your standard taxable brokerage accounts. That way, they can compound exponentially, and the IRS isn't taking a bite out of your apple every single year.
This really hits the nail on the head when it comes to the golden rules of asset placement. Notice how passive ETFs and municipal bonds belong right there in your taxable accounts? Why? Because they naturally generate way fewer taxable events. Or, in the case of muni bonds, the interest is actually often tax-free. On the flip side of that, you have active funds and taxable bonds. Those generate a ton of ordinary income and short-term capital gains. So those absolutely belong in your tax-advantaged accounts, like your IRA or 401k. Over there, that massive tax drag is completely neutralized. That makes perfect sense conceptually, John, but let's jump into Section 3, Best Taxable Account Assets, and look at the elite choices. I want some concrete, real-world examples. What exactly should the everyday investor be buying when they log into their taxable brokerage account today? I love that. Let's get incredibly specific. The absolute top-tier assets for your taxable accounts are passive ETFs, like the SPDR S&P 500 ETF, which everybody knows is SPY. It charges practically nothing, just 0.09% in annual fees, and it has incredibly low turnover. Next up, you've got municipal bonds, which yield interest that's typically completely exempt from federal taxes. And finally, individual stocks, but only provided you hold them for more than 1 year so you qualify for those sweet, long-term capital gains rates.
Now, just look at the stark contrast here between passive and active investing. When you buy a passive index fund, you're essentially just owning the whole market. You aren't triggering this constant cycle of buying and selling. And if you hold those passive assets for over a year, your gains are taxed at the much, much lower long-term capital gains rates, which are just 0, 15, or 20% depending on your income. But if you're using actively managed funds in a taxable account, that fund manager is constantly trading, which triggers short-term capital gains. And those are taxed exactly like your ordinary paycheck. That is a massive wealth leak you have to avoid.
Once you've mastered those basics, it's time to graduate to Section 4, Direct Indexing and Tax Harvesting. This is the high net worth upgrade. This is exactly how the wealthy scale up and actively drive down their tax burdens.
Okay, wait, let me jump in. A lot of wealthy people actually got rich because they worked for a single super successful company, or they just went all in on one stock. How does a wealthy person manage the massive risk of having, say, 50% of their entire net worth tied up in a single concentrated stock position?
That's the exact problem direct indexing solves. See, with a standard ETF, you own a fund that holds the shares. It's completely rigid. You can't tweak it. But with direct indexing, you, the investor, are actually buying the individual stocks that make up the S&P 500. It's incredibly customizable. So, let's say you already have millions tied up in Apple stock from your day job. You can use direct indexing to buy the rest of the S&P 500 and purposefully exclude Apple. That safely neutralizes your risk while keeping you perfectly diversified.
But the real genius of direct indexing is tax loss harvesting at the individual stock level. Think about it like this. Let's say you own all 500 stocks in the index. The overall market might be having a great year, but Coca-Cola is down 10%. You can systematically sell Coca-Cola to harvest that exact loss, which you then use to magically erase the taxes on your gains elsewhere. Then, you immediately replace it with a similar company, like PepsiCo, to maintain your market exposure. Doing this systematically can boost your after-tax returns by up to 1% annually. That right there is pure tax alpha.
That is honestly brilliant. But let's do a quick reality check for the average earner here. Direct indexing is incredibly powerful, sure, but it typically requires anywhere from $250,000 to $500,000 in investable assets just to get your foot in the door. For the vast majority of everyday investors out there, standard low-cost ETFs are still going to remain the absolute best, most practical choice for a taxable account.
You are entirely right, Monique. ETFs are the undisputed engine of middle-class wealth. But let's look at the absolute end game with Section 5, the buy, borrow, die play. This is the ultimate wealth preservation strategy used by the ultra-rich. And get this, it's a completely legal framework developed by Professor Edward J. McCaffrey back in the 1990s.
All right, here's the millionaire playbook in 3 simple steps. Step 1, you buy appreciating assets, like real estate or a really robust stock portfolio, inside your taxable accounts. Step 2, and this is crucial, you never sell them, ever. Instead, you borrow against them, using those assets as collateral. Because loan proceeds are not considered taxable income, you get cash to live your luxury lifestyle completely tax-free. And then step 3, you die and pass those assets to your heirs. Under current tax law, they receive what's called a step-up in cost basis. That means all that capital gains tax you spent your life avoiding, it's completely wiped out.
Just let this quote from Professor McCaffrey really sink in for a second. Since debt is not taxed, it makes sense to avoid capital gains taxes on assets that have appreciated by borrowing against them. That is the whole secret. Wealthy people don't sell assets to get cash, they use debt as an impenetrable tax shield.
Okay, I have to jump in again, because this sounds crazy. Doesn't this strategy carry massive, terrifying risks? I mean, if I borrow heavily against my stock portfolio or my real estate and the market crashes, the bank is going to issue a margin call or foreclose on my properties. Forced liquidation during a crash means I lose literally everything. Plus, don't you need millions in equity to even get lenders to give you these favorable lines of credit in the first place?
I agree with your skepticism completely, Monique. You hit the nail on the head. Buy, borrow, buy is a high-wire act meant for the elite, and it can absolutely ruin you if you don't have deep enough pockets to weather a market storm. So let's bring it back to reality and pivot to Section 6, your blueprint for wealth. Let's look at the actionable steps for the average earner.
But real quick, before we cover the final, most crucial steps to getting your money right, take a second to subscribe to RichTrybe's channel. Like, comment, and share. It genuinely helps us keep bringing you these high-level wealth strategies.
All right, the bridge from being an average earner to a high net worth investor isn't some magic trick. It's built on daily, consistent habits. First, treat your savings like it's a non-negotiable bill. Automate your transfers to your brokerage and retirement accounts the exact day you get paid. Set it and forget it. Second, redirect any found money. When you get a tax refund or a bonus at work, do not go buy a new TV. Invest it. Third, build multiple income streams to really increase the velocity of your investing. And finally, conduct an annual financial check-in to ensure your asset allocation strategy is actually doing its job and minimizing your taxes.
Because at the end of the day, wealth is built one intentional step at a time. The data consistently shows us that whether you choose to use dollar-cost averaging to invest smaller amounts monthly or lump sum investing when you have a chunk of cash, the absolute most critical factor is your time in the market. Consistency, paired with the tax awareness we just discussed today, is your true wealth builder. So it really just comes down to looking under the hood of your own portfolio today and figuring out exactly where the leaks are.
Exactly. Which leaves us with one final, critical question for everyone watching this explainer. Are your taxable accounts silently leaking wealth to taxes right now, or are you finally ready to restructure your assets and invest like a millionaire? The choice is yours. Thank you for joining us on RichTrybe.